On February 5, 2026, crude oil futures jumped within minutes of confirmed Israeli strikes on Iranian-linked targets in Syria, according to Bloomberg reporting that same day. Brent crude rose sharply in early trading as investors reacted to fears of regional escalation. But here's what mattered more than the price spike. It wasn't the missiles, it was the map. Because just south of Iran lies the most economically sensitive choke point on Earth, the Strait of Hormuz. Nearly 1/5 of the world's oil supply flows through it every single day. If that artery tightens, the global economy feels it instantly. The U.S. Energy Information Administration estimates that roughly 20% of global petroleum liquids consumption moves through the Strait of Hormuz. That's not regional trade, that's systemic infrastructure. Saudi oil, Iraqi oil, Kuwaiti exports, UAE shipments, all pass within range of Iranian naval capability. And Iran has reminded the world of this before. In 2019, after heightened tensions with the United States, Iranian officials publicly warned that if their oil exports were blocked, others in the region would not export safely either. It was not rhetoric, it was strategic signaling. Energy markets today are more fragile than they were a decade ago. After Russia invaded Ukraine in 2022, global oil trade routes were redrawn. Europe cut reliance on Russian crude. Asian buyers shifted contracts, shipping patterns elongated, insurance costs rose. According to the International Energy Agency, spare global production capacity has narrowed significantly compared to pre-pandemic levels. That means there's less cushion, less margin for error. And when supply cushions shrink, volatility grows. On February 8, 2026, analysts quoted by Reuters warned that even a partial disruption in Hormuz could send oil prices sharply higher within days. Notice the wording, not closure. Disruption. Markets price risk ahead of reality, and risk perception in the Gulf has risen. Shipping insurers have historically increased premiums during heightened tensions in the region, which directly raises transport costs before a single barrel is physically blocked. Fear is expensive. The United States produces more crude oil than any country in the world. But oil is globally priced. When Brent rises, gasoline in Ohio rises. When shipping costs increase in the Gulf, grocery bills in Texas feel it weeks later. This is basic transmission economics. Federal Reserve is already walking a tightrope between growth and inflation. A sustained oil shock would complicate that balancing act. During previous oil surges, bond yields responded immediately. Because energy prices influence inflation expectations. Inflation expectations drive interest rate policy. One regional flare-up can ripple into mortgage rates. That's how connected this system is. Israel's security doctrine prioritizes preventing Iran from gaining advanced military capability in the region. But every military action carries economic implications. According to coverage by the Wall Street Journal in February 2026, Israeli defense expenditures have risen amid heightened regional tensions. Higher defense spending means budget reallocation. Markets factor in fiscal strain quickly. The Tel Aviv Stock Exchange experienced volatility following reports of escalation. Not collapse, but caution. Investors price uncertainty immediately. Capital hates unpredictability. Iran cannot match the United States militarily. It does not need to. Its leverage lies in geography and asymmetric capability. The Strait of Hormuz is approximately 21 miles wide at its narrowest point. Shipping lanes are even narrower. Iran's naval forces have invested in fast attack craft, anti-ship missiles, and coastal defense systems precisely for deterrence signaling. Even limited harassment of tankers in past episodes, such as the 2019 tanker incidents, triggered global concern. No full blockade occurred. Yet markets reacted, because credibility matters. And Iran's signaling is understood by traders. China is Iran's largest oil customer. Energy security underpins Chinese industrial stability. According to reporting by Bloomberg in early March 2026, Beijing has maintained cautious diplomatic language while monitoring energy routes closely. China does not want escalation. Its economic model depends on stable imports. A Hormuz disruption would raise import costs, pressure manufacturing margins, and ripple into global supply chains. The world's second-largest economy has direct exposure. Russia benefits indirectly from higher oil prices. Energy exports are central to Moscow's fiscal revenues. Middle Eastern instability drives crude upward. Russia's energy receipts rise. But escalation also complicates its geopolitical balancing. It cannot afford full regional war. Energy windfall is beneficial. Uncontrolled chaos is not. This is not black and white alignment. It is strategic calculation. Energy feeds everything. Oil gives transport, transport gives food, food gives inflation, inflation gives interest rates gives asset prices. In 2022 and 2023, inflation reshaped global politics. Central banks raised rates aggressively. Consumers absorbed higher borrowing costs. If oil spikes meaningfully again, central banks face a dilemma: raise rates further and risk recession, or tolerate higher inflation. Both paths are costly. Markets know this. That's why oil volatility affects equities within minutes. Higher oil prices hit import-dependent economies first. Currencies weaken, debt servicing costs rise, capital flight accelerates. During past oil shocks, the International Monetary Fund warned that energy volatility disproportionately affects fragile economies. Now imagine tight global liquidity, high debt burdens, and renewed energy shock. That combination is combustible. Full-scale war is dramatic, but slow-burning tension is economically worse. Weeks of naval alerts, insurance premium hikes, shipping reroutes, speculative trading that keeps oil elevated without headlines. Elevated oil sustains inflation pressure. Sustained pressure influences rate policy. Rate policy influences markets. This is how geopolitics becomes financial stress. Quietly, gradually, then suddenly. Even temporary disruption could remove millions of barrels per day from global circulation. Traders would anticipate shortage. Speculation would amplify price movement. Insurance rates would surge. Importers would scramble for alternatives. Strategic petroleum reserves might be tapped. But reserves are finite. Price expectations faster than governments release statements. That speed is the danger. This conflict is not just about Iran and Israel. It is about whether the global economy, already strained by debt, inflation, and restructuring, can absorb another energy shock. Because if it cannot, the consequences extend far beyond the Middle East. They reach household budgets, investment portfolios, interest rates, and political stability. And that's only the economic surface. But Iran was not just trying to survive sanctions. Iran was trying to redesign the chessboard. And the most interesting move began quietly. In the East, not in Washington, not in Europe, but in China. In March 2021, something happened that many Western media outlets barely explained. Iran and China signed a 25-year strategic cooperation agreement. This was not a normal trade deal. It was a $400 billion partnership. Energy, infrastructure, telecommunications, ports, railways, military cooperation. And one important thing hidden inside this agreement: oil payments outside the US dollar system. That matters more than most people realize, because the entire global oil trade mostly runs through the petrodollar system. If countries start trading oil without dollars, they slowly weaken Washington's financial power. And Iran knew that. Then came 2022, a year that changed global geopolitics. In February 2022, Vladimir Putin launched the Russian invasion of Ukraine. The West responded with massive sanctions against Russia. And suddenly something interesting happened. Iran and Russia found themselves in the same position: sanctioned, cut off from Western banking, excluded from the SWIFT network. So they did what isolated countries often do. They started building their own systems, trade routes, payment networks, energy alliances, and military cooperation. In 2023, Western intelligence agencies made a claim that shocked many observers. They said Iran had supplied Shahed drones to Russia. These drones were reportedly used in the war in Ukraine. Washington reacted immediately. The US Department of the Treasury imposed new sanctions. And Joe Biden warned that Iran was deepening military cooperation with Russia. Iran denied some accusations. But the message was clear. The global power blocs were rearranging. For decades, the biggest geopolitical tension in the Middle East has been between Iran and Israel. And this rivalry is not just political. It is strategic, military, and ideological. Israel believes Iran is trying to build nuclear weapons. Iran insists its nuclear program is for peaceful energy purposes, but the world saw the tension explode several times, especially around the Joint Comprehensive Plan of Action. In May 2018, Donald Trump made a dramatic announcement. The United States would withdraw from the Iran nuclear deal. Standing in the White House, Trump said, "This was a horrible, one-sided deal that should never have been made." Immediately after that announcement, Washington restored severe sanctions on Iran. Iran's economy took another shock. Oil exports dropped, inflation surged, currency collapsed. But something unexpected happened again. Iran adapted, instead of relying on Western markets. Iran began building influence through regional networks, groups and allies across the Middle East, in Lebanon, in Syria, in Iraq, and in Yemen. Critics in Washington call this the Iran proxy network. Iran calls it regional resistance. Either way, it expanded Iran's influence far beyond its borders, without requiring a massive traditional military. Now here's where things become fascinating. Despite decades of sanctions, Iran still managed to maintain major industries: steel production, petrochemicals, automobiles, missile technology, and energy exports. According to estimates from the International Monetary Fund, Iran still holds some of the largest oil and gas reserves on Earth, second largest natural gas reserves, among the top oil reserves globally. Which means one thing: even if the economy struggles, the strategic value of Iran never disappears. However, survival does not mean stability. Inside Iran, economic pressure is intense. Inflation has surged multiple times. Youth unemployment remains high, and protests have erupted in several periods. In 2022, nationwide demonstrations followed the death of Mahsa Amini. The protests spread across major cities. The government faced serious domestic criticism. Even supporters of the government admit the economic model is under heavy stress. Another hidden battle is happening in the financial world. For decades, global trade has depended on the US dollar, but countries like Iran, Russia, and China are experimenting with alternatives. Local currencies, barter trade, gold settlements, even digital currencies. Some analysts call this the slow fragmentation of the dollar system. Others say the dollar will remain dominant for decades. But the experiment has started. Iran is one of the laboratories. Another hidden battle is happening in the financial world. For decades, global trade has depended on the US dollar, but countries like Iran, Russia, and China are experimenting with alternatives. Local currencies, barter trade, gold settlements, even digital currencies. Some analysts call this the slow fragmentation of the dollar system. Others say the dollar will remain dominant for decades, that the experiment has started, and Iran is one of the laboratories. So the real question is not, is Iran strong, or is Iran weak? The real question is, how long can a country survive under constant pressure from the world's most powerful economies, while simultaneously building alliances with their rivals? Because history shows something interesting. Empires collapse, sanctions regimes change, alliances shift, but countries that learn to adapt under pressure sometimes emerge stronger than expected. In geopolitics, power is not only about wealth, it is about endurance. The ability to absorb shocks, to bend without breaking, to lose battles, but stay in the game. May not be the richest country. It may not have the most powerful military. But after decades of isolation, sanctions, and conflict, one thing is undeniable. Iran is still standing on the global chessboard. And the next move might change the entire game. History shows that economic pressure can weaken countries, but sometimes it forces them to adapt. The real question now is not whether Iran survives sanctions. The real question is, what happens if the global balance of power starts shifting because of it? If you want to see more informational videos like this one, invading financial realities behind the geopolitics, subscribe to the channel and share to someone who is interested in global issues and economy.